In this next section, we're going to look at the various types of dividends that companies can pay out to their stockholders. The first of those dividends is cash dividends. So cash dividends are a return to our investors. They also tend to increase the stock's market value. To pay a cash dividend, the corporation has to have a balance in retained earnings and the cash necessary to pay out that dividend. So we have to have available cash flows and the savings in our retained earnings. When we declare a dividend, on the date that we declare the dividend, we record the liability for the dividend. The date of record is when we stop trading for those stocks that are getting a cash dividend. On the date of record, that records everyone who is a current owner of that stock. That whoever is the current owner on the date of record gets the dividend. So if I sell a stock after the date of record, I would get the dividend and not the new owner. The date of payment is the date that the payment of that cash dividend goes out to stockholders. So when we look at this example, on January 9th, $1 per share cash dividend is declared on our 5,000 common shares outstanding. The dividend is paid on February 1st to all stockholders of record on January 22nd. So we've declared we're going to pay a stock dividend to anyone who still owns the stock on January 22nd. But we're going to pay that out on February 1st. So first we record a liability. We remove $5,000 from retained earnings and we create a dividend payable to pay out our cash dividend. On February 1st, we pay those cash dividends. There's no journal entry for the date of record. That is simply the date at which the owners of the stock are recorded, and we determine who gets the dividend for that stock. If we do not have enough money in retained earnings to pay for a dividend, we then have a deficit. So this is when we have losses or we pay dividends greater than our total profits earned in other years. In this example, we have a retained earnings deficit of $6,000 because we've paid stock dividends out greater than what we had saved in our retained earnings of $6,000. We can also do stock dividends. So stock dividends can be used to affect the market price. So we can help if we think the market price is too high, we might do a stock dividend to help bring that market price down a little bit because we want to encourage people to buy it. Another reason we might do stock dividends is because we don't have available cash flows or we're saving that cash flows or retained earnings for another purpose, but we still want to give something back to our investors. We have small stock dividends and large stock dividends. So a small stock dividend is anything less than 25% of our previously outstanding shares. And a large stock dividend is if the distribution is 25% greater than the previous outstanding shares. We're going to look at an example of a small stock dividend. They get recorded differently in our accounting records. We have 10,000 shares of $10 par stock outstanding. On December 31st, we declare a 10% stock dividend. The stock was selling for $15 per share. The new stock will be distributed to stockholders on January 20th. So we had 10,000 shares, we're doing a $10,000 or 10% stock dividend. So we're distributing 1,000 additional shares to our current holders. So if I have 10 shares, I'm going to get another share of stock. Now I'm going to have 11 shares, part of this 10% issuance. We are going to debit retained earnings for the market value of those shares of stock. We're going to create a common stock dividend distributable and then at par, and then record that we have paid in capital in excess of par value. On our stockholders' equity account, you can see the before the dividend, how our stockholders' equity looks. Then at the date of declaration, we have the common stock dividend distributable and the paid in capital in excess of par value. On the date of payment, we remove that $10,000 to our common stock and remove it from the common stock dividend distributable. Now you see that we have, after our dividend, we have 15,000 less in retained earnings. We have 13,000 in paid in capital excess of par value, and we now have a common stock account of $110,000, which is a 10% increase. So our record on the date of distribution would be to move that from common stock dividend distributable to the common stock account. For a large stock dividend, so remember the large one is over 25%. For a large stock dividend, here we have a 30% stock dividend. So we're going to do 3,000 shares instead of 1,000. We record those at the par value. So we capitalize our retained earnings for the minimum amount required by state law for a large stock dividend. So that's our par value. We're going to debit retained earnings for 30,000 and credit our common stock dividend distributable, 30,000. In either case, we're going to have additional shares of stock. A stock split is a distribution of additional shares of stock to the current stockholders according to their percent ownership. So in this example, we are looking at a 2-for-1 stock split. So for every share I have, I'm now going to have 2. You double the shares of stock and you reduce the par value. So if I had a $20 par value and I did a 2-for-1 stock split, now I have twice the number of outstanding shares and I have split my par value in half. When we look at the financial statement effects of dividends and splits, for a cash dividend, we decrease total assets because there is a payment out in cash. We decrease retained earnings, which decreases our total stockholders' equity. For a small stock dividend, we're going to increase common stock, increase our paid-in capital in excess of par, and decrease retained earnings. For a large stock dividend, it's an increase to common stock and a decrease to retained earnings. A stock split has no change to any of our total amount of dollars in any of our accounts. So if you see the par value in the first example, we have a common stock of $20 par value times 100,000 shares. That amount is exactly the same as $10 times 200,000 shares. So there is no total change in the money that is recorded in that account on our financial statement.